Hey YouTube, welcome back to another video. This is My Financial Focus, and in this video I'm going to be doing an investment review on Palantir Technologies business and their stock. Over the last week it's up 6%, the last month it's up 6.35%, 18.86% in the last 3 months, 144% in the last year, and it went public September 30th, so since then it's up 159%. And this is a business, just a couple of fun facts here, that started off as a software platform, and it was built primarily to help the United States military fight the war in the Middle East. And the primary goal was to help US soldiers and allied forces locate targets and integrate data in an efficient way to help them understand their information better. And this was just to help them save people's lives and also save time. And then they've diversified their two main systems, which are right here. We can see Palantir Foundry and Palantir Gotham, away from simply only serving military institutions, and then towards serving as well corporations and business institutions in order to help them make decisions across dozens of different structures and production lines. Their software is currently being used in 150 different countries in 40 different sectors, including consumer, financial services, telecommunication, energy, healthcare, industrial, and transportation sectors. And so in this video, I'm just going to be doing an intrinsic value analysis of their stock to try to figure out what a good buying price would be for us to buy into it as value investors. And I'm also going to be reviewing their annual report to try to figure out how the business makes money, what they do, their risks, their competition, their growth strategies, and then also look over their financial statements to end off the video, because it's always good to understand a company's financial health if we're going to be investing in it. So if you're new to the channel, be sure to leave a like, comment down below what y'all think of the video after it's over, subscribe to the channel if you're new, and let's get right into it. So the first thing that I'm going to need if I want to find the intrinsic value of their business using this discounted cash flows model is their growth rate from years 1 through 5. I can easily find that just by going to Yahoo Finance, going to the analysis tab for Palantir, scrolling down, and we can see that the estimated growth for Palantir over the next 5 years is 49.39%. So I'm just going to put that in right here. For the growth rate for years 6 through 10, I'm just going to be conservative and say 10%. We can always play around with this value afterwards to see what the intrinsic value of the business would be based on different growth rates. For the year 1 free cash flow, I'm just going to go to TradingView and type in Palantir. Click on this, pull up financials, go to cash flow, scroll down, and we can see that their free cash flow over the years has actually been negative. So that's not a good sign, but for their trailing 12 months free cash flow, it's 105.30 million. So I'm just going to use that for this example. Actually, let me do this. Okay, and then their net cash minus net debt. If we go to Yahoo Finance and then scroll up, go to the statistics tab, we can see total cash 2.34 billion and total debt 249 million. If we subtract that from each other, we get 2.9 billion. Stock ticker Palantir, and then shares outstanding. Last thing we need here is 1.87 billion. So after plugging in all those values, we can see the free cash flow that's estimated for the next 10 years plus the terminal value, which is what we would theoretically sell the business for in year 10. And then the present value of these cash flows discounted back by the 10% discount rate. And we can see that based on these values, the intrinsic value per share for this discounted cash flows model is $4.24 per share, which compared to the current share price would make it seem that Palantir is currently a little bit overvalued. But then again, like I said before, this discounted cash flows model isn't fully comprehensive. It's not a perfect tool, but it is a tool that we can use as reference when trying to figure out what the intrinsic value of a business is. Let's say we were to play around with the growth rate here and bump this up to 49%. So that's matching the growth rate for years 1 through 5. That would say that the intrinsic value per share is $11.94, which still makes Palantir a little bit overvalued. So again, this isn't fully comprehensive, but based on this model, Palantir would have to grow more than 49% in either years 1 through 5 or years 6 or 10 in order to justify the $25.97 share price that Palantir is currently trading at. The price that they went public at was about $10. So based on that, if it were to grow at 49% from that point, then it would be valued around intrinsic value, but that's neither here or there. Like I said, it's not fully comprehensive, but it is a tool that we can use. Okay, so the next thing that I want to do is go into their annual report and just break down a couple of things about their business so we could better understand what it is that we're investing in. If I were to scroll down here a little bit, I will get to their business overview where they talk a little bit about their history, but they also talk about their two main platforms, which are Gotham, Palantir Gotham, and Palantir Foundry. These are two platforms that have technical abilities, and they make it easier for data engineers to integrate new data sources. They make it easier for analysts to clean and transform data, for data scientists to write models, for business users to conduct their daily workflows, and also for senior leaders to make critical day-to-day business decisions. The next thing I want to look at after that is page 18, which talks about Palantir's competition and their competitive edge over their competition. Some of the ways that Palantir, or the main way that Palantir sees themselves as highly competitive in this space and what gives them their competitive advantage is that they started off as a business platform that was providing services for the United States government. And so that's an experience that a lot of software companies that they're competing against don't really have. So they're able to bring that high level security mindset that they developed from providing services for the government and then apply it to corporate America and business institutions, which is something that gives them a big advantage over other software platforms that are inexperienced in that area. Also, because Palantir has experience now in providing solutions for businesses and corporations, they're also able to bring that private sector experience to the government, which is something that a lot of software companies that are primarily government-based don't have experience doing. So they have the best of both worlds since they provide value for the government and for corporate America. They can take their experience from one end of that spectrum and apply it to the other end, which gives them a pretty big leg up over their competition. So their growth strategies for the foreseeable future are to expand their operations in the private sector and then also to diversify away from just government and more towards corporate America in every industry, and then also to expand their global footprint internationally, specifically in Europe and Asia. The next thing that I want to talk about is right here, their risk factors. I always think it's important to analyze a business's risk factors if I'm going to be investing in it, because I want to know what I'm getting into. And if the share price of Palantir suddenly drops, then I can have some reasons in the back of my head for why I think that that might be happening. One of the main risks that Palantir faces is that they currently are not profitable, and they've actually been losing money since their inception. And so that obviously poses a great risk because their business model at the moment is currently primarily just being financed off of share issuances and also bank loans and debt. So that obviously could impact their profitability in the future. Also, increased competition and less demand for their platform in the future could destroy their growth opportunities, and also termination of existing contracts that they have, as well as the inability of them to perform on their current contracts, could also be a detriment to their future revenues. Not to mention that their leadership in their CEO, Alexander Karp, if he doesn't remain motivated and make good decisions along with all the other leadership in the business, like most businesses, and their revenues could obviously suffer in the future. Brand recognition plays a big part in Palantir's revenues, so they have to enhance and maintain their brand, otherwise their revenues may suffer. They obviously face intense competition in this area because providing software for the government is very serious and it's highly competitive. Everybody always wants the best software, so Palantir is definitely going to have to up their game in that regard. And one thing that I found very interesting here, I forgot what page it's on, but somewhere along the line when I was reading in their annual report, they touched on how they don't really want to interact, not necessarily interact, but they don't want to have to work with the Chinese Communist Party in China. And so expansion into China, which is the second biggest economy in the world, is something that Palantir has chosen not to really consider, which I think could definitely impact their revenue growth, considering that, like I said, it's a pretty important part of the global economy. Here it is. We do not work with the Chinese Communist Party and have chosen not to host our platforms in China, which may limit our growth prospects. So I definitely think that that could be a risk, but that's a risk that Palantir is willing to take. The question is if it's a risk that investors are willing to take. And the last thing that I want to touch on here is that Palantir obviously has a growing debt, considering that their business isn't profitable. It's fully financed based on just debt and share issuances. So that could obviously pose risks in them being able to carry out their future business operations. So the next thing that I want to look at here is their financial statements. And we can see right here, this is their income statement. We can see their revenues have increased from 2018 to 2020. In 2018, it was about $595 million. In 2020, it was about $1.09 billion. Gross profit has also increased, but they obviously are not profitable, mainly because they're spending so much in sales and marketing, research and development, and general and administrative costs. If we scroll down a little bit here, we can see their revenues broken up into percentage. So from their top line down to their bottom line, we can see what percentage of their total revenues they're spending on sales and marketing, research and development, and general and administrative expenses. And that's particularly why they're experiencing a net loss, because obviously out of 100% of their revenues, they're spending like 175% on total operating expenses. So they're having to finance their current business operations. We can also see a breakdown of their revenue right here between how much revenue they created from their government sector of their business and the commercial sector of their business. In 2020, they produced about $610 million from the government and also $482 million from their commercial revenue sector. And if we scroll down a little bit here, we can see the cost of revenue, the gross margin, and the sales and marketing expenses broken up by change in percentage from 2019 to 2020. Their sales and marketing expenses have increased 50% from 2019 to 2020, 83% for research and development, and 109% for general and administrative expenses. So their operating expenses keep on going up, but they're still unprofitable. And like I said before, that's one of the main risks facing Palantir at the moment. Next thing I want to look at is page 101. We can see right here, this is a quick little glimpse at their cash flow statement. We can see from their operating activities, they did not produce any money from their operating activities. They lost money. And so financing is the main way that they are being able to continue their business operations. They raised $46 million in 2018. Is that 40? Yeah, 46 million, and then 324 million in 2019, and then they raised over $1 billion in 2020. Next thing I want to do is I want to go to page 111. Right here we can see this is their balance sheet. We can see their total current assets right here have increased, nearly doubled from 1.2 billion in 2019 to 2.2 billion in 2020. Their total assets have increased from 1.5 billion in 2019 to 2.6 billion in 2020. Total liabilities have actually decreased, which is a good sign, from 1.4 billion in 2019 to 1.1 billion in 2020. And their total stockholders' equity has increased as well. It was actually, from what it looks like, negative in 2019 at a negative 1.9 billion, but it's now positive 1.5 billion at the end of 2020. Right here we can see their income statement again. And then if we scroll down a little bit more to page 117, we can see a bigger, more in-depth look into their cash flow statement. We can see the details of everything that's getting added back from the income statement that is a non-cash expense, which shows that their net cash from operating activities was negative. We can see what they're investing in. Purchase of property and equipment, as well as purchase of equity method investments, are their two biggest investment activities. And then from their financing activities, we can see that they actually paid back some of their debt, principal payments on borrowings, $400,000, and a lot of the money that they raised came from issuance of common stock. So if people were holding shares from 2019 to 2020, which obviously wasn't the case because they went public in September 30th of 2020, but for the investors that got in a little bit earlier, they were certainly diluted by the financing activities of Palantir. Next thing that I want to look at is page 141. This is the second to last thing that I'm going to be going over, which is right here, just a quick little chart showing the dilution from 2019 to 2020. We can see that they had, of their Class A shares, they had 2.2 billion Class A shares authorized in 2019, and that went up to 20 billion in 2020. So that's a lot of dilution in that short amount of time. And then lastly, I want to look at page 153, which is a geographic breakdown of their revenues to see where they're generating their revenues from around the world. We can see that 52% of their 2020 revenues came from the United States, 12% from the United Kingdom, 9% from France, and 27% from the rest of the world, making up the full 100% or $1 billion. And their United States revenues have actually been increasing from 2018 to 2020, from 35% in 2018 to 52% in 2020. Not sure if that's necessarily a good thing. From my experience, when I'm investing in a business, I typically like to find businesses that diversify their revenues outside of only the United States. But that's up to each investor to determine if this sort of business model or if the risks that I went over are within their risk appetite for their potential investment. That's pretty much all I wanted to go over for Palantir. Just wanted to do a quick little intrinsic value analysis of their business, try to figure out what a good buying price would be for them. Let me know what you guys think about Palantir, if you guys are holding any shares, or if you guys think that it's a good investment, or if you guys will be investing in it in the future. Be sure to leave a like on the video and subscribe to the channel if you haven't already, and I'll see everyone in the next one.